Hey there, my friends. In this video, I just want to really quickly show you the type of trading that I actually do. What I actually do is called Harmonic Pattern Trading. And what that is looking for patterns in the market that utilize specific Fibonacci retracement and extensions to actually find the patterns and the probability of success of those patterns working out. So let's go ahead and jump into the charts and let me show you exactly what I'm talking about. So this is typically the way that I have my charts. I don't have my charts with anything on them. I don't have moving averages. I don't have stochastics or MACD or anything like that. I only have just plain candlestick charts. And I have them in this color because I am colorblind. So I have some candles in a light blue, some candles in a dark blue. My light blue candles are bullish candles. My dark blue candles are bearish candles. But what I'm looking for primarily are harmonic patterns, and I identify them by looking for certain things in the market. So I first identify what's called an impulse leg, and an impulse leg is something that sticks out in the market. Something like this. This big move here would be considered an impulse leg. Same thing right here. This move right here is an impulse leg. It is very identifiable, and it also breaks previous structure. So we can see that this move here breaks all of this previous structure right here. It sticks out like a sore thumb to me, and that catches my attention. The next thing I look for is a retracement on that impulse leg. So we can see here, so if I go over here and pull out my Fibonacci retracement levels, we can see that this impulse leg is followed by, in this case, a 78.6% Fibonacci retracement. So this particular pattern that I'm looking at now would be considered a butterfly pattern, just because of this particular point, which what we would call a B point, is at a 78.6% Fibonacci retracement level. Now, most harmonic patterns are in what we call a W or an M shape. We can see in this particular pattern, this is a W shape. So this is a bearish pattern because in the end, when we enter the market, we want the market to go short. So we're going to get in hoping that the market goes down. That's why it's considered a bearish pattern. So in this case, if I actually show you what the pattern would look like, this is what the pattern would look like when it's completely finished. This is a butterfly pattern. And where we would get into the market is at the 127 extension of the CD leg. And you can see these points here. We have the X point, the A point, the B point, the C point, and the D point. The D point is our entry point. That's where we're going to get into the market. And we want to get into the market and we want to see the market go in this direction from that point, because that's how we're going to make our money. And where do we want to take our profit, and where do we want to keep our stop loss at? I always believe you need to have a stop loss. So first thing first, we want our stop loss to be somewhere above the 141 extension. So we want our stop loss to be somewhere above here. So we're going to enter at this 127. We want our stop loss here. And where do we want our target to be? So we want our target to be somewhere down here, and we have a precise measurement for that. So we're going to take our Fibonacci retracement again. We're going to go from our A point to our D point. And I'm going to change these to my target template and move these over just a little bit so that we can see. And this 38.2% area, that is where we are going to take our profit. So if we actually do something like this, if we get in here at the 127 extension, we went just past 141. We get in here at the 127 extension, we move this to our stop, and we take this all the way down to where we are going to take our target. We can see that we have a 2.42 to 1 risk reward ratio. That's fantastic. Really, anything over a 1-to-1 risk reward ratio is good. You don't want to get less than 1-to-1, and you don't need to get above a 2-to-1 or 3-to-1, 4-to-1. Yes, those are nice, but it's not necessary. There will be a lot of people that tell you you have to have it. That's not true. It really depends on, one, your money management system, two, what percentage of wins do you have? You know, if you're only winning 30% of the time, maybe you do. Maybe you need 4-to-1, 5-to-1, 6-to-1, but you don't need a ton. For us, because we're winning 73 to 83% of the time, a 2-to-1 risk reward ratio is just fine. Plus we use a money management system that most people don't, and we make a lot more money for it. So I just really quickly wanted to show you what type of patterns I look for in the market. And I can do this type of trading in any type of market. I can do this in stocks. I can do this in Bitcoin or any type of currency. It doesn't really matter what I'm looking at. If it's a chart, if it is a candlestick type chart, I can find these patterns in the market. And that is what's so fantastic about it. So if you learned something, if you like this video, go ahead, hit the thumbs up, share it, leave me a comment down below, and let me know your thoughts. Until next time, take care. Peace.